Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking some of the very important articles which have appeared in various business related newspapers and we'll be analyzing these particular articles. For this particular video, I've chosen the time period from 13th to 26th of July 2020 and the articles that I've chosen are from Business Line, Hindu, Business Standard, Indian Express and Live Mint. Let's begin the discussion. The first article is related to two types of subsidies. One is the food subsidy and the second one is fertilizer subsidy. Let me discuss some of the very important points before taking up the points given in the article. First and foremost, Government of India provides huge amount of financial assistance in the form of subsidies. What do you mean by a subsidy? In simple terms, it is an assistance given by the government to achieve certain objective either to a household, either to an individual or to a company. So in order to achieve an objective, certain assistance either in the form of a cash assistance or in the form of a aid, one or the other form, this kind of an assistance will be provided by the government. And when you convert this into money terms, this is basically referred to as a subsidy. Now two very important types of subsidies which are incurred regularly by the government is one fertilizer subsidy and the second one is food subsidy. Now first, points related to food subsidy. Government of India runs various types of food distribution programs. Is it okay? Government of India runs various types of food programs under which certain beneficiaries are identified and the food is subsidized to them at a very low rate. For example, Government of India runs the most important food distribution program, National Food Security Act. Apart from this, there is an Integrated Child Development Scheme. There is also Midday Meals Scheme, etc. Under all of these particular schemes, what is a common thread? The common point is government ensures that certain types of food or food grains are available to the beneficiaries at a very lower price. For example, under National Food Security Act, Government of India provides 5 kgs of food grains per person per month. Under this, rice will be sold at 3 rupees per kg, wheat is being sold at 2 rupees per kg, and coarse grains are sold at 1 rupee per kg. This is generally the issue price. What do you mean by issue price? Imagine you are the government, I am one of the beneficiaries. If you supply 1 kg of a rice to me, then I will be paying 3 rupees for this particular 1 kg of a rice. This particular price is called as a issue price. Now this is important for a simple reason. This is decided by the government and once the NFSA has been implemented, after the implementation, the issue price has remained constant. But very recently, please be very careful, Government of India to these particular sections of the society is providing the food grains or certain amount of food grains free of a cost. Why? Because of the pandemic, these particular households have been hit very badly. To minimize the impact of the COVID, the Government of India is providing certain amount of food grains free of a cost. Now, what is the issue with respect to all of this? First and foremost, generally Government of India incurs huge amount of a food subsidy. Annually, the amount of food subsidy that is incurred is over 1.5 lakh crore rupees. Again, I am giving you an average number. It will vary from one year to another year and the general trend has been that it has been on an inclining trend. That is the first point. Second point, Government of India will roll over some of the subsidy. What do you mean by rolling over? I'll take a very simple number here. Imagine this year Government of India has allocated 100 crore rupees for food subsidies, but it actually requires let's say 150 crore rupees to provide the food grains to these particular beneficiaries. Government will not increase the allocation, rather government will ask the authority, that is Food Corporation of India, to borrow from the market. How much is the shortfall here? Shortfall in this particular context is 50 crore rupees. FCI will borrow 50 crore rupees from the market, basically from NSSF, National Small Savings Fund. And this particular borrowing will be used to bridge this particular deficit or the shortfall in the food subsidy. In simple terms, from one year to next year, FCI has kept on borrowing from NSSF, as a result of which the overall liability or overall debt has kept on increasing. Not only this, when you borrow from someone, obviously will have to pay interest. So the government is also providing for interest on this kind of a borrowing. And this particular interest has been increasing over a period of time. All of this is basically covered under the concept of off-budget financing. What do you mean by off-budget financing? The mechanism which is generally followed is the budget will be introduced in the parliament. The government has to get the approval of only then any amount will be allowed to be withdrawn by the government from Consolidated Fund of India. But under the concept of off-budget financing, government though is incurring the expenditure is not taking the permission of the parliament. It is basically bypassing, circumventing the traditional process. Hence, this is basically referred as off-budget financing. CAG has flagged this particular practice of the government of India for a simple reason. In recent times, it has increased by a very large margin, as a result of which CAG says the actual fiscal deficit is much more than what is actually mentioned in the government documents. Now, apart from this, what information has been provided in this particular article? As already mentioned, FCI will keep on borrowing from NSSF. So what is the outstanding liability as of this year from the NSSF? This article mentions that as of now, that is as of March 31st, 2020, FCI already has an outstanding debt or outstanding liability of 2.5 trillion rupees. In addition to this year, Government of India has allocated how much? 1.1 lakh crore rupees in the budget. But with increasing allocation, that is specifically of the food grains which are allocated at a very cheaper price, increased procurement under MSP, the food subsidy bill will be very high. And in addition to this, there is also a concept of a decentralized procurement. What is the idea for decentralized procurement? Generally, procurement is done by the central government, then the food grains are distributed to the states, and then these are distributed to the beneficiaries. But on behalf of the central government, or instead of the central government, the states will procure the food grains, and these will be used for distribution to the beneficiary. For having conducted the procurement operations on behalf of the center will provide certain amount to the states. This is a basic idea for decentralized procurement. And as per this particular article, this year the government of India will have to incur anywhere around 20,000 crore rupees in the form of a decentralized procurement. So I'll put everything in a nutshell now. In terms of a food subsidy, government of India has allocated 1.1 lakh crore rupees. There is an outstanding debt of 2.5 trillion as of now. In addition to this, free food grains are being provided for a certain period of time, which obviously will mean what? More subsidy burden for the government. And finally, because of a decentralized procurement, government will have to provide more than 20,000 crore rupees to the states. All of these particular numbers put together, this article says the overall expenditure of the government on food subsidy for this particular fiscal will be a large number, that is 5.7 trillion rupees or 5.7 lakh crore rupees. So government allocation is just over 1.1 lakh crore, whereas the overall expenditure in food subsidy will be 5.7 lakh crore rupees, which means there will be a huge overshooting of fiscal deficit. Either this will be one of the outcome. Second, government will have to ask Food Corporation of India to borrow more money from NSSF, which again means what? The overall debt will increase, interest payment will also increase. This is one part of the article. The second part of the article discusses fertilizer subsidies. If you see the trend of allocation of fertilizer subsidy over a period of time, specifically between the financial year 1920 and 2021, that is the current fiscal compared to previous fiscal. In the previous fiscal, the allocation was around 80,000 crore rupees. I'm just rounding off the numbers. And in this particular financial year, it has been reduced, or the budget allocation has been reduced to 71,309 crore rupees. In simple terms, in terms of allocation, 11% allocation has been reduced. That's the first point. Second point, in addition to this, the Ministry of Fertilizers has been classified as a Category B ministry. What do you mean by this? With the onset of the pandemic, the government of India realized that whatever amount has been allocated in the budget, the same amount of expenditure will not be incurred in this particular financial year. On one side, certain ministries will require huge amount of expenditures. On the other side, certain ministries will be asked to cut down their expenditures. For this particular purpose, government classified the ministries into three categories: category A, category B, and category C. Any ministry that has been classified as a category A will be allowed to incur the expenditure that has been allocated in the budget. Category B, either ministry or department, they will have to reduce their expenditure. How much? If 100 rupee has been allocated in the budget, they will be allowed to incur only 80 rupees out of this in this particular fiscal, which means 80% of the allocated funds shall be utilized. Now, obviously the full financial year will be having 4 quarters. So this particular 80%, many of the times, if you come across in the newspapers, they will say per quarter it will be reduction of 20%. Now you can understand this. Per quarter 20% reduced, for full financial year it will be 80%. Next, if you are a ministry which is classified as a category C, then your expenditure for this particular fiscal will be limited to 60% of the allocated expenditure. And per quarter, the cut in the expenditure will be 15% like this. So, Minister of Fertilizers has been allocated or has been categorized as category B ministry, which means the allocated expenditure, whatever it is, it will be cut down in the present financial year. So, on one side, allocation itself is 11% lesser compared to previous fiscal. Second, this particular allocation has been cut down or has to be cut down because of the government guidelines. And the third one, just like in case of a food subsidy, even in case of fertilizer subsidy, there is an outstanding amount. That is, in the last couple of years, the expenditure has been higher than whatever has been allocated. So there has been rolling over of the subsidies. Now I keep on using the term rolling over. It simply means the subsidies payment will be postponed or delayed. For example, imagine you are FCI, I am the government of India. This year, I'll take the same example that I had taken earlier. I had allocated 100 crore rupees, but you incurred 150 crore rupees. So the difference is how much? 50 crore rupees. So you will be borrowing from NSSF this 50 crore rupees in this particular fiscal. But I will not be paying this 50 crore this year itself. I'll be paying it in the next couple of years. Or in the future, I'll be making this particular payment. So what I'm doing is basically rolling over these particular expenditures. So rolling over of budget financing, all of them have been flagged by Comptroller Auditor General's report very recently. So coming back to the discussion here, just like the food subsidies, even the fertilizer subsidies have been rolled over from the last couple of years. And the outstanding amount is more than 40,000 crore rupees. So the allocation is lesser, it has to be scaled back. There's already an outstanding liability. As a result of this article mentions that the overall fertilizer subsidy that will be incurred by the government will be to the tune of 1.2 lakh crore rupees, which again means government will not be able to incur this amount. It has to roll over these particular expenditures, borrow from the market. So overall, this particular article says that because of these two types of subsidies, the expenditure burden of government of India will be very, very high. To overcome this particular issue, either the government will have to monetize the deficit from RBI. Second, will have to borrow under the concept of off-budget financing. Only then the fiscal deficit will be brought down, or else the fiscal deficit will be very, very high. This is the gist of the article given here. Now based on this, let me take up a question here. The economic cost of food grains to the Food Corporation of India is the minimum support price and bonus, if any, paid to the farmers plus. This particular question basically is asking you the formula for the economic cost of food grains. Now what do you mean by economic cost of food grains? In simple terms, if you are the government, I am the beneficiary, to supply the food grains to me. I repeat, to supply the food grains to me, what is the expenditure incurred by you? In simple terms, what is the overall expenditure incurred by the government to basically run these particular food distribution programs? Now to find out this, all you need to do is follow the supply chain system. What are the activities done by the government in order to ensure that the food grains will reach the beneficiary? What are the activities? First, government has to procure them, that is a food grain. then government has to transport these particular food grains. Government has to store or warehouse it. Government, if it has borrowed from someone else in the market, has to pay interest on these particular borrowings. Government also has to pay distribution cost. These are generally the expenditures incurred by the government in order to ensure that the food grains will reach the beneficiaries. So when the government procures the food grains, government will pay a price which is called as minimum support price. I repeat, minimum support price is the price which is paid by the government when they procure these particular food grains from the farmers. Majorly procured food grains in India are rice and wheat. So when government or government agency purchases these particular food grains, they will pay a price. This is called as MSP. So basically the formula will be boiled down to MSP plus procurement incidentals. All these are considered to be procurement incidentals, and finally the distribution cost. Apart from this, if the state government is giving any other type of let's say incentive, it will be referred as bonus. Now look at the formula. The economic cost of food grains, which is nothing but this particular formula, to the Food Corporation of India is the minimum support price plus bonus, if any, paid to the farmers, plus what is the component missing? The component missing is procurement incidentals plus distribution cost. So the right option will be option C. Now that is a discussion related to the first article. So let me go to the next article, which is related to the concept of import substitution. In recent times, Government of India has been formulating many of these particular policies or is implementing many of these particular guidelines in order to basically promote the concept of Atmanirbharta or self-reliance through the idea of import substitution. Now what do you mean by the basic concept of import substitution? Imagine there is a particular sector. This particular sector, in order to produce the final goods, is importing certain commodity. It could be raw material, it could be intermediary goods, it could be anything. So rather than importing this and then producing the final goods, Government of India is basically promoting the production of this particular product in the domestic market. Is it okay? Through various guidelines, measures, policies, so on and so forth, Government of India is basically saying whatever is required, you will have to manufacture in the domestic market itself. Although they are saying that you need to produce them, they are not basically prohibiting the imports. You can understand this. Government of India cannot simply say that you will not be allowed to import. What Government of India will do is, with imposition of various tariffs, quotas, restrictions, government will promote the production of these kind of goods which are imported in the domestic market itself. Now what is the objective? Objective is to simply reduce the import dependence. For example, India is heavily dependent on imports from China, be it essential commodity or non-essential commodity. We import huge amount of these particular commodities or let's say goods or merchandises from China. As a result of this, whenever there are trade disputes or whenever there are any kind of disputes between these two countries, the one country which has an upper hand will be the country which has an upper hand in the trade also. So in order to reduce the dependence on these kind of imports, Government of India is basically promoting the idea of import substitution. But please understand, this is not the first time that the Indian government is basically promoting the idea of import substitution. Post independence also, the Government of India had brought in the same concept of import substitution. Basically we had put certain restrictions on the imports and basically said whatever is required, we will manufacture in the domestic market itself. That again doesn't mean that there were no imports, but it essentially means government was making it difficult to import these particular commodities. For example, there was a licensing regime. Even today, you must have heard of this. Government of India is imposing this particular concept of a licensing regime on some of these particular imports. For example, some types of tires are under the licensing regime for imports now. Import of smart color TVs has been restricted with the concept of a licensing now. So understand this, idea of import substitution is the idea of a self-reliance, which means we will manufacture them in India. It doesn't mean that we will not be importing them or government will not be allowing the import of these particular commodities. Even if Government of India says I am not going to allow, The exporting countries will basically go to WTO, file a complaint against India, and much before that, they will also be banning the exports from India into their market. So, idea of import substitution is not very new, but please understand, like I said, post independence, we had implemented this particular idea of import substitution that led to inefficiency in the domestic market. That is a precise reason, couple of decades ago, we actually withdrew this particular idea of import substitution. Now, what actually happened was basically this. In case of India, whenever you prohibit these kind of imports, or to put it more precisely, when you promote this idea of import substitution, it basically means that domestic companies are given more preference compared to the imports. And when these particular domestic companies have come to know that our products are preferred compared to the imports, they have become very relaxed. Adoption of technology or latest technology has been very, very slow. The efficiency in the market or the movement towards the efficiency has been very, very slow. Despite promoting these particular domestic companies, the overall production, the market prices have not come down as per the expectation. The best example for this even today is the idea of a solar photovoltaic modules. In case of India, more than 80% of these particular solar photovoltaic modules are imported from the global market, and majority of them, without any surprise in India, come from China. Now, Government of India, in order to promote the domestic production of these particular modules, imposed a duty on the solar photovoltaic modules which were coming from China and Malaysia. These particular duties are referred as safeguard duties. But with imposition of these particular safeguard duties, has the production of these particular commodities or products increased in India? Have we been able to replace the Chinese products with the domestically manufactured products? Even today, there is a problem with respect to this particular sector in the domestic market. For a simple reason, the technology which is being used by these particular companies is inferior compared to the technology used by Chinese manufacturers. The pricing in case of China is much competitive compared to the pricing of these particular products which are manufactured in India. Have a look at this. Even in case of automobile sectors, we import huge amount of commodities from China, spare parts from China. Despite importing, incurring tariffs, paying transportation cost, these particular products, when they reach the Indian consumer, or let's say the automobile sector companies, are 12 to 15% cheaper than the domestically manufactured companies. So the previous experience has been that despite implementing this particular concept of import substitution, it has not provided or it has not improved the functioning of these particular companies. That is a precise reason various experts have basically warned Government of India that you are basically using the old failed formula. What is the guarantee that it will improve in the present situation or it will work out in the present context? So that is a basic discussion which has been provided in this particular article. This particular term was mentioned in the article, that is basically it has been mentioned in last but one paragraph. That is basically the discussion is China is one of the biggest manufacturers or producers of rare earths or rare earth metals, and these particular rare earth metals are required in many of the sectors. For example, in case of let's say manufacturing of telecom equipment, in case of manufacturing of smartphones or smart TVs or any kind of electronic goods, these kind of rare earth metals are required. India does not have a huge amount of a production of this, but this particular article mentions that very recently 3 public sector enterprises have come together, formed a joint venture, and they have set up a new company, that is Khanij Bidesh Limited. And this particular company will be mining out or basically looking or scouting for these kind of rare earth metals from countries such as Argentina, Bolivia, Chile, South Africa, Australia, etc. So this is a point given here. Based on this only I have picked up a question. Consider the following statements about Khanij Bidesh Limited, Kabil. It is a joint venture between HCL, Hindustan Copper Limited, MECL, Mineral Exploration Company Limited, and NALCO, National Aluminium Company. This particular point is correct. Second, all the 3 companies own 1/3 ownership stake in this particular joint venture. This particular statement is wrong. Please make a note of this. In this particular Khanij Bidesh Limited, 40% stake is owned by NALCO and the remaining 2 each own 30%. So total 100%. So that is the right point and this particular point is wrong. So the right option will be option A, only first statement is true. I've given a descriptive question also. The policy for import substitution should be a fine balance between current requirement and future value creation. You will have to elaborate and write it in 250 words. Let me take up the next article which is related to managing of the public debt. First and foremost, what do you mean by public debt? Understand this, government will be borrowing from the market. Why does government borrow from the market? For a simple reason, its expenditures are higher than its receipts or income sources. In order to incur this amount of an expenditure, government borrows from the market. Now this particular borrowing could be domestic or foreign. But please understand this, the government borrows on consolidated fund also, apart from having a liability of a repayment in public account. What do you mean by this? Under the Constitution of India, I'm pretty sure you've come across these two types of accounts. There is one consolidated fund of India and the second one is public account. The basic difference is, in case of consolidated fund of India, the government will have to take the permission of a parliament before withdrawing any amount. And government will be borrowing over the consolidated fund of India, or the repayment of liability will also be done through consolidated fund of India. But apart from this, there is another type of a borrowing, or there is a liability of the government, basically under the concept of public account. So please understand this. The overall repayment or overall debt or liability of the government will be because of a borrowings on consolidated fund of India, as well as the liability or the repayment that it has to do under the public account. Now, whenever I say the concept of a public debt is basically associated with the borrowings in the consolidated fund or over the consolidated fund of India. And this particular public debt will be either in the form of a domestic borrowings and foreign borrowings. In case of India, more than 95% of this particular borrowing is in the domestic market, and remaining 5% or just around 5% is because of the government borrowings from various multilateral institutions or multilateral international organizations such as World Bank. So these are some of the very, very important points. Now to put it in a nutshell, please follow this particular equation here. Public debt will be internal debt plus external debt. And overall liability or overall repayment that has to be done by the government is because of public debt, which is associated with the borrowings under the consolidated fund of India, plus the liability that the government of India has on the public account. Having said so, also remember this. These are just the liabilities which are there on the paper. That is, these are the guaranteed liabilities. There is another concept of a contingent liability, very, very famous in the current concept or current affairs. What do you mean by contingent liability? Let me go very, very simple example. Government very recently has provided the concept of a credit guarantee. In order to address or ease the pain of the pandemic, it has announced the concept of a credit guarantee. What is the meaning of this? Under one concept, the companies will be borrowing, and if they don't repay, this particular amount will be guaranteed by the government. This is one type of a contingent liability, which means right now it is not a liability. But if these particular securities are revoked, if this particular guarantee is revoked, who is liable to repay the amount? It will be the government. I'll give you another example. Government, that is a center, will also provide guarantees for borrowings are done by the state. And if the state government doesn't repay, who is supposed to make the repayment? The repayment will fall on the shoulders of the government. All these are the examples of contingent liabilities. Contingent liabilities means these are not the liabilities right now, but in the future they may actually become the liabilities. So these are some of the very, very important basic concepts related to concept of a public debt. Now what is given in this particular article? The article basically says that with the pandemic taking effect on the global market, the public debt of all the countries of the global market has kept on increasing. As per this particular article, it mentions, that is IMF has reported that the overall global debt, that is of government, will increase from 83% of global GDP for the year 2019 to 100% of
the global GDP.
This has been mentioned in the article. Now, specifically coming to the facts related to India.
The debt to GDP ratio for India has increased to 87 point or will increase to 87.6% in this particular fiscal.
As per one of the committee reports, that is Encasing committee report, the overall debt to GDP has to be reduced to 60% of GDP, which has been accepted by the government, which was supposed to be met or which was supposed to be achieved by 2022-2023. Now, because of the pandemic on one side, as a result of which income tax receipts or overall receipts of the government taking hit and expenditures increasing, the debt also has increased. And this particular article mentions that since the debt has kept on increasing, rather than achieving it by 2022-23, it may take 7 more years after the deadline to actually bring it down to 60% of GDP. That is another very important point mentioned here. As per the article, the debt to GDP ratio has increased from 67% of GDP from 2011 and 12 to 72% in 2019 and 2020. In essence, even before the pandemic, the debt to GDP ratio has been increasing. So what is the way forward? The government of India has to take one very important structural reforms, has to monetize the deficit, or it has to cut down the unnecessary expenditures in certain areas in order to maintain this particular debt to GDP ratio. But one very important flag that has been raised in this particular article is related to monetization of the deficit. Now, what is the meaning of monetization of deficit? In simple terms, Government of India will be selling the G securities directly to RBI, taking money from RBI. I repeat, in simple terms, monetization of a deficit means rather than selling the G securities or auctioning the G securities in the market, government will be selling the G securities to RBI, taking the money from RBI. And since RBI gives the money, generally we say that monetization of the deficit will lead to printing of these particular currency notes. And the problem with respect to this is when the RBI prints or basically pumps huge amount of money like this through Government of India in the system, the basic problem with respect to this monetization of deficit practice is once RBI gives the money in the hands of Government of India, it is akin to saying that huge amount of money has been pumped into the system. So the money supply in the market will increase. This will lead to inflationary trends in the market. Now the issue with respect to even this particular point is that right now the situation is there is inflation in the market which has happened because of supply side constraints. That is because of the pandemic, the supply has got disrupted, as a result of which the prices of these particular commodities have kept on increasing and the demand has been suppressed. Now if you pump more money into the system, there's a danger that the demand might spike, which will simply take the inflation rate much higher level. So that has been one very important issue which has been raised against the concept of a monetization of deficit in this particular article. Now based on this particular discussion, let's discuss a question here. Consider the following statements. Public debt involves internal as well as external debt. Correct statement. Public debt represents the overall debt or liability of the central government. No. Apart from the public debt, there is also liability in the form of a public account. So second statement is wrong. Right option will be. Next question. In the context of the pandemic having an impact on the finances of the government, there is a need for the center to take certain structural reforms. You will have to write in 250 words. Now let me take up the next article. The next article is related to inflation. Now in the recent times, one of the very important issues that has been discussed threadbare in the newspaper articles has been the concept of inflation in the Indian market. This has happened for a simple reason. As per Monetary Policy Framework Agreement or under the concept of inflation targeting, the highest level of inflation allowed in the Indian market is 6%. That is as per MPFA. RBI has been asked to maintain the inflation rate at 4% but with a variance level of plus or minus 200 basis points, which simply means RBI can allow the inflation rate to hit 6% or to drop up to 2% if not at 4%. So obviously the fact is you cannot always maintain inflation rate at exactly 4%. There will be volatilities in the market. So to what extent the inflation rate fluctuation is allowed? It is allowed to fluctuate up to 6% or fall up to 2%. That is the duty of RBI in terms of controlling the inflation. But as per the recent data which has been released, the inflation for the month of April, May and June have been 7.2%, 6.3% and 6.1%. So you can see that for 3 consecutive months here, which has been mentioned in the article, the inflation rate has been over or beyond the rate of 6%. Now this will create a headache for Reserve Bank of India. Why? On one side, if inflation rate is over 6%, RBI has to control the inflation rate, bring it down under control. In order to bring the inflation rate under control, what generally RBI does is reduce the interest rates in the market. Now, why this particular inflation rate of 6% is very, very important? Now, please understand this. As already mentioned, as per MPFA, RBI is supposed to mention the inflation rate at 4% plus or minus 200 basis points, which means if inflation is over, let's say 6%, that is a variance level for RBI, RBI has to take certain measures. Although I'm using the term RBI, generally who does this particular decision? It is the Monetary Policy Committee. Now what will be the decision made? Whenever the inflation rate is higher, let's say in this particular instance more than 6%, what decision will be taken will be basically to increase the interest rates. The idea is increase the interest rates. With increase in the interest rates, borrowing becomes costly, inflation rate is expected to come down. But on the other hand, when interest rates become higher, borrowing rates are higher, it also means that the lending will get affected, the investments in the market will get affected, as a result of which growth will be affected. So in simple terms, just remember this. Whenever RBI increases or MPC increases interest rates, the objective is to control inflation. And when they reduce interest rates, the objective is to promote growth. But in the present context, this particular situation has created a dilemma for the central banker. Because on one side, interest rates is taking a hit in India, and on the other side, inflation rate is more than 6%. If RBI wants to control inflation, generally it will go for a hike in the interest rate. But if they do that in the present context, it will send a negative signal for borrowers in the market or investors in the market, as a result of which growth will get affected. But on the other hand, if they reduce the interest rates, there is a danger that inflation rate will spike much higher. So this particular issue has been discussed at various forums or in different articles, as RBI is supposed to make its latest monetary policy review. So this is a basic discussion which has been given in this particular article. Now based on this, I have given a question here. The inflation trend makes it tricky for the MPC to decide on the interest rates. Elaborate in 250 words. So these are some of the very important articles as well as the questions related to articles for this particular time period. Thank you. Have a good day.